This is Robert Kraft, and I'm coming to you live on SNN Live, and we're at the New Orleans Investment Conference 2018. And with me right now is a familiar face on our program, Mr. Rick Rule from Sprott Global. I got two symbols for you because it's a publicly traded company, SPOXF in the U.S. and SII on the TSX. Rick, welcome back.
Pleasure to be with a second generation of Kraft.
It's a pleasure to have you as always. So for our audience, let's start off with your background, who you are, a little bit about Sprott Global, and then we'll get into it from there.
Sprott is a Canadian domiciled and listed company. We manage or administer something like $11 billion in assets in precious metals and natural resources. I would suspect that we're the largest manager of MicroCap resource equities in the world. I am, as you can see, sort of a 45-year veteran of natural resource markets, mostly in the small and microcap space.
Okay, so you're here at the New Orleans Investment Conference. You're a speaker. What has been your topic of conversation today?
What I was asked to speak about by the conference sponsor was what I'm doing with my own money right now. Many of the speakers here give recommendations about what they think people should do with their money. Brian London, who puts on this conference, said, I think my clients would be most interested in what you intend to do with your own money in the next 12 months, not what you think other people should do. So that was my assigned topic, and I had fun giving the talk.
Well, what are you doing with your own money right now?
I'm doing three things in the speculative side of the business, which is what he asked me about. The first thing is that I believe that we're heading back into a mergers and acquisition cycle. The industry has underallocated capital for 8 years, which means that the industry is very much project constrained. The way that you deal with that in the near term is you buy other companies. As we've seen recently as an example in the Randgold-Barrick merger, the urge to merge is large. We've identified at Sprott 35 companies that we think are reasonable takeover targets. We're refining this list to what we believe are the 7 to 10 best. And I will be buying those companies in anticipation of them being bought by other companies over the next 18 months. I'm sorry?
I was going to say, along the 7 to 10 best, what is your criteria for those 7 to 10?
Great question. The first is one that you'd like to own anyway, irrespective of whether it gets taken over. Pure takeover speculation is interesting, but sometimes you're wrong, so it has to be a company that you would like to own. Presumably, if you would like to own it rationally, somebody else would like to own it. We want a Tier 1 or at least a high Tier 2 property. We want materiality, at least 1 million reserve ounces of gold, capable of producing over 100,000 ounces of gold a year, or its economic equivalent in other metals. Importantly, we want to know who that asset is strategic to. We believe that mergers, we hope rather, that mergers in the future are less for scope and scale, and rather that they are strategic. So we want to know who the likely buyer is, and hopefully we want a circumstance where the asset is strategic to more than one buyer, so that an auction process ensues. So materiality, value, and a strategic outcome that we can understand. So
just for those who may not know, what's the difference between a Tier 1 and Tier 2 property?
Well, I guess that depends on who you are. A Tier 1 property is a sort of a multi-generational property. So in the gold business, you'd be looking at 5 million ounces plus. A property with in situ values that probably exceed $7 billion. In the copper space, you'd want in situ values that probably exceed $10 billion. One where, in terms of capital efficiency, that is the return on capital employed, the returns are 30% plus, and ones where the all-in sustaining costs are in the bottom cost quartile worldwide.
So another question that I have for you, and this is based on some interviews I've done with some project generators and some gold royalty companies, and what I've been noticing is that, a lot of them are developing portfolios of their own colleagues and their own brethren. One company went so far as to say is, most of the companies in that room, we actually have them in our portfolios. So to me, it seems like that's been an interesting trend going on in the business. Do you have a comment on that?
It's a prescient question. At Sprott, we're obviously in the business of providing debt and equity to mining companies. The most competitive sector in the mining business in terms of the provision of capital is now other mining companies. What you're finding is that the mining companies themselves have replaced the generalist investor and are beginning to replace some of the industry-specific investors. Now, you need to understand yourself that when a prospect generator acquires a share in another mining company as partial payment for a property, that position is not part of a portfolio, but rather is held for resale. So you can't really regard them as long-term shareholders. Often when a mining company farms out a project to another project, the company that's farming into the project wants to save their cash to use it as exploration expenditure, which is also what the prospect generator wants. Right. So the prospect generator will take shares in the company that's farming in hopes that if the exploration effort is successful, that in addition to benefiting from their carried interest in the property, that the shares that they hold also goes up.
See, that was my assumption, is that they become now long-term shareholders because as some of our audience, are value investors, so you would think that that would be the natural course of action.
Your audience should remember this. When a mining company holds shares in other mining companies and they do a financing, that is, they raise money by selling their shares, what they're telling you is that the shares of the company that they held are more valuable than their own shares. It's a very bad sign when a mining company issues shares in themselves and keeps shares of other companies in their portfolio. They are either empire building or they know more about the value of their own shares than they would like to tell you about.
So what are some other trends that you're seeing going on in the natural resources space?
Well, two other sectors that I'm investing in, royalty and streaming, which is a fairly mature sector. It's a sector that some people won't buy because they think that the period of high growth is behind them, and I think the period of high growth is ahead of them. Because we compete in mining finance every day, we know that streaming contracts are an increasingly important part of the mine finance landscape in the sub-investment grade mining companies. So we believe that there are $5 or $6 billion worth of transactions that could occur in the streaming space every year in the context of mine finance. Everyone knows that the margins that the streaming companies enjoy relative to regular mining companies are great. By way of example, over the last couple of decades, the return on capital employed enjoyed by the best of the best mining companies is about 15%. Well, the streamers enjoy 60% margins. So the fact that they sell at an EBIT multiple over the producers is easy to understand because the margins are so much larger. What isn't broadly understood is that these companies can and will continue to grow, and that's why I own them. The third sector that appeals to me is one that you just mentioned, the prospect generators. I believe that the mining business, by its nature, is not an asset-intensive business, but is rather an intelligence-intensive investment. I believe that these companies in the exploration stage are research and development companies. The prospect generators use their commercial and technical acumen to generate exploration theses, and they farm out the interest in the property. In other words, you dilute your interest at the property level where the probabilities against success are high, and you maintain your interest in the intellectual capital because you don't dilute the share ownership in the structure. I love those businesses. I've been investing or speculating in those businesses for many years. Let me give you an example why. When I was in university, when many of these deposits were being formed,
you don't have to date.
I was taught that 1 in 3,000 mineralized anomalies becomes a mine, which means that the value proposition put up by general exploration is a 1 in 3,000 chance of success. Take a 1 in 3,000 chance to get a 10-to-1 return. It makes the lottery look like a good deal. I've invested, I believe, in 65 prospect generators in 35 years in the exploration business. I've enjoyed 24 economic discoveries and 22 takeovers. So the juxtaposition of risk to reward is 1 in 3,000 or 22 out of 65. I was told by a very smart intern, my math isn't good enough, I was told that that's 3 standard deviations better response. Not 3 times, 3 standard deviations better response. Now, arguing with that arithmetic is impossible to do.
So, would you say this is a result of this trend in royalty streaming and project generators? Is that a result of where we're currently at in the cycle?
No. I would say that irrespective of cycle, high-margin businesses like streamers beat low-margin businesses like miners. And I would say that irrespective of the cycle, that understanding that exploration is a knowledge business, not an asset business, is important. At this point in time in the cycle, the 3 different strategies I'm employing are taking place for 3 different reasons. Mergers and acquisition, because where we are at the cycle, coming out of a bear market, going into a bull market, that's the sector that moves first. This is the 5th time I've done this. The first time I was too young to understand what was happening, but although I learned slowly, I learned.
I was going to say, sorry, I didn't mean to cut you off, but like the reason I ask, I think, is because I did an interview with Brent Cook a couple times, and he always says, you're not going to finding those new bonanza discoveries are just even more fewer and far between nowadays. So I guess that's where my question was really coming from, where it seems that you want to look more at some of these companies that are looking at multiple different properties as opposed to betting on that one big bonanza right there in Canada. You'd say,
Yes, but irrespective of cycle. The truth is that prospect generators have worked better than general exploration for 35 years, and they will do so for the next 35 years. At some point in time, maybe 30 years from now, somebody will be interviewing you about the mineral exploration speculation business, and you will know as a consequence of arithmetic that although prospect generation is boring, it pays.
So, sorry, I did cut you off there. So what was that last trend that you were talking about? Yeah.
The first one was M&A. The second is streaming. And streaming is appropriately valued, which most people don't realize because most people think the streamers can't grow, which is wrong. The streamers can grow. The consequence of that is that the multiple that you're paying is worthwhile, while the risk is much, much lower.
So, in your opinion, where do you see us right now or where do you see the natural resources business going into 2019?
I hate saying this because your readers won't like this. Nobody has the ability to forecast only 12 months in the future. If you give me 5 years, I can.
5 years.
If you give me 5 years, I can tell you that we will have a rip-snorting bull market. Bear markets are the authors of bull markets, which most people don't understand. The bear market that we have been through in natural resource equities is really truly one for the record books. Normally, cyclical declines in junior mining stocks are 50 or 60% declines. This was a 90% decline. Now, I'm not suggesting that the recovery has to be proportionate. What I am saying is that bear markets are the authors of bull markets, and bull markets are the authors of bear markets. Whether or not this, quote, blessed event occurs in 2019 or not is something that's way, way, way above my pay grade. But this I can tell you, the answer to the question begins with when, not if.
So, for our audience, let's get more. Where can our audience go and get more information on Sprott Global?
We would love to visit with your audience. They can visit us online at www.sprottglobal. They can call us at 800-477-7853. And as a special offer, I've done this before, any SNN subscriber that cares what I think can email me their natural resource portfolio. It's important that you give me both the name and the symbol. And it's important that you do it in the text because I'm not smart enough to open up all these attachments. And I will rank your natural resource holdings and email them back to you on an absolutely no obligation basis.
My name is Robert Kraft, and I'm coming to you live on SNN Live. And we're at the New Orleans Investment Conference 2018. With me again has been Rick Rule from Sprott Global, publicly traded company, 2 symbols for you, SPOXF in the U.S. and SII on the TSX. Rick, always a pleasure.
My pleasure. Thank you.